Why do you buy at the top and sell at the bottom? We'll explain this with a quote by Bob Farrell, a Wall Street veteran. He said, "When all the experts and forecasts agree, something else is going to happen." Bob Farrell's quote captures one of the oldest truths in investing. The market tends to surprise the majority. When every expert, analyst, and media outlet is in agreement, whether bullish or bearish, odds are the market is about to go the other way. This isn't just a contrarian cliché. It reflects how consensus thinking tends to be priced in. By the time you hear this stock can only go up, it likely already has. And when everyone expects a crash, they've probably already sold. Herd mentality and FOMO, or fear of missing out, drive people to buy at peaks and sell at lows. Exactly the opposite of what you should do. Some key takeaways. Consensus is dangerous. If everyone agrees, there's usually no one left to act on that view, meaning no more buying pressure and a high risk of reversal. You're not early, you're late. When your taxi driver or cousin is giving stock tips, the top is probably near. Crowds are emotional. Mass psychology plays a massive role in markets. Euphoria and panic are contagious and costly. Markets discount the future. By the time a bullish narrative hits the headlines, it's often already baked into prices. Some real-world examples. The dot-com bubble in the late 1990s. Everyone was convinced that internet stocks were a new paradigm. When the bubble burst in 2000, trillions were lost. The housing bubble in 2007. Real estate always goes up, was the mantra. We all know what followed in 2008. A financial crisis with collapsing investment banks like Lehman Brothers. Bitcoin at 69K in 2021. Major hedge fund, celebrities and retail investors jumped on the Bitcoin and cryptocurrency train at the top, shortly before a sharp correction of 80 to 90%. So what are the lessons for investors? 1. Don't chase hype. Be cautious when an investment is universally loved. Iconic investors like Warren Buffett emphasize the importance of buying when others are fearful and selling when others are greedy. 2. Be skeptical of mainstream sentiment. The market moves ahead of the news cycle. Focusing on what everyone already knows, the obvious information that's widely accepted and accounted for, rarely leads to significant gains. In investing, this is known as priced-in information. Once a fact or trend is well known, it is usually already reflected in the asset's price. 3. Develop independent thinking. The best opportunities are found when you're willing to be early, lonely, and sometimes wrong before being right. Making informed decisions means doing your own homework. Blindly following the crowd increases your risk of falling victim to the same mistakes as the majority. 4. Build a strategy, not emotion. Dollar-cost averaging and value investing are more reliable than trying to time euphoric rallies. By focusing on non-consensus ideas and betting on the unexpected, investors can find valuable opportunities that others miss. Contrarian thinking, when grounded in analysis, can lead to significant rewards. You always buy at the top and sell at the bottom, not because you're foolish, but because that's when the noise is loudest, the confidence is highest, and the risks are most hidden. Bob Farrell's quote reminds us to be cautious when consensus becomes gospel. Markets don't reward comfort. They reward courage, discipline, and independent thought. For more insights, visit quotesonfinance.com.